Okay, thank you all for making it today. So in the last class, we started talking about this new section of the course on exchange rate policy and the central bank. And I think we mainly accomplished kind of reviewing what a nominal exchange rate is, right? It's the price of a foreign currency in terms of the domestic currency. We talked a bit about changes in the exchange rates, appreciations versus depreciations, or a strengthening or a weakening of the dollar. And then we started to try to develop a model of how exchange rates fluctuate over time, right? I showed you guys some actual data between the United States and Japan on how the value of the dollar relative to the yen has kind of changed quite dramatically over the last 20 years or so. That model of how exchange rates are determined is going to be based on simple kind of demand and supply characteristics or attributes in the market for foreign currency exchange. All right, and I think this is basically kind of where we got to in the last class. All right, so we're going to use this model several times today, in particular to analyze how a central bank like the Federal Reserve can sometimes intervene in foreign exchange markets to influence the exchange rate, okay? So remember, in these types of models, you have to pick a home country and a foreign country. For us, we're going to assume that the home country is the US, and so the quantity of foreign exchange that is traded in this model is going to be the quantity of dollars that will potentially be swapped for Japanese yen in our example. The price of foreign exchange is just the exchange rate, right? Represented in terms of yen per dollars. We've got a standard downward sloping demand curve and an upward sloping supply curve. Now again, really quickly, why does the demand curve slope down in the exchange rate? In other words, as the yen-dollar exchange rate declines, that is, as the dollar weakens relative to the yen, we have that the quantity of dollars demanded is going to rise. And why is that? Yes. That's right. If the dollar weakens relative to the yen, then US goods and US assets become cheaper for Japanese consumers and investors, right? So they're going to want to demand more dollars in order to acquire those goods and assets, right? So the demand for US dollars is going to increase as the exchange rate falls. Lauren, what about the supply curve? Why is it upward sloping? So as the dollar strengthens, we have the supply of dollars in this market going up, or the quantity supplied going up, I should be exact. Who's they? Let's be real clear about this. US consumers and investors. Exactly. As the dollar strengthens, Japanese goods and Japanese assets become cheaper relative to their US counterpart. And so consumers and investors in the US then want to take advantage of those lower prices by swapping dollars for yen. And so the supply of dollars in these foreign exchange markets is going to increase. Good. Those are a little bit more confusing to understand than a lot of people realize, okay? Okay, the exchange rate then should bounce around in this market in order to balance the supply and demand of dollars in the foreign exchange market, okay? And that's how exchange rates are determined in the short run. And of course, the big implication of this then is that when we observe fluctuations in the exchange rate on a day-to-day basis, they're reflecting underlying shifts in the supply or demand for dollars relative to some whatever foreign currency we're talking about, okay? Let's do a couple of examples of these together, all right? Okay, so here's the scenario. Let's suppose I ask you kind of the following question. Let's suppose that let's say Japanese consumers, so we're still going to use the US versus Japan as our home and foreign country. Let's suppose that Japanese consumers suddenly want to increase their demand for a US product, like a US made tablet computer, okay? So that event happens in the market, all right? It's just random or whatever. What I care about are the implications of that change on the yen-dollar exchange rate. Does the dollar strengthen or does it weaken relative to the Japanese yen in this case? Okay, so to set these problems up, what you want to do is draw your demand and supply for US dollars in exchange for yen. Okay, be very careful about how you label all of these things. It's the quantity of dollars on the horizontal axis, since that's the home currency, and the exchange rate is yen per US dollar on the vertical axis. All right, here's our initial equilibrium point at, let's say, 80 yen per dollar. All right, what happens here if suddenly Japanese consumers have an increase in their desire for a US made product, like a US made tablet computer? Santiago? Sorry? Yes. So Japanese consumers want to purchase this product, but in order to do so, somebody somewhere has to convert yen into dollars to buy those things. And so there's going to be an increase in the demand for US dollars in these foreign exchange markets. And Santiago, all else equal, what is going to happen then to the exchange rate? It's going to, the dollar is going to appreciate, right? So now a dollar is going to be worth 85 yen, right? If you want to think about the transition here, at the old exchange rate, as soon as the demand shifts, Santiago, you have demand exceeding supply. So you have a shortage of US dollars in these foreign exchange markets. Whenever there is a shortage, the price of the good is going to be bid up in order until the equilibrium is reestablished. Perfect. Okay, easy example. Let me say this though. It's important for you guys to recognize that there are many factors, and I'm not going to presume to list all of them, that can cause an increase in the demand for US currency in foreign exchange market. All right. Here is a list of 5 of, I think, probably the most common. All right. And the one that I just gave an example kind of falls under the first category. If there is a sudden increase or greater foreign preference for US goods, right? All of a sudden, Japanese consumers want to buy a lot of US made tablet computers. That increases the demand for dollars. There are some other ones that I think are important that I want to talk about just for a few minutes here. Or perhaps you can talk about them. Higher US interest rates. Why would that cause an increase in the demand for US dollars? Lauren? Exactly. I think that's the key thing. If US interest rates are higher, then US assets are going to have a higher kind of expected return relative to Japanese assets. Japanese investors would like to take advantage of those higher returns, but to do so, they have to convert yen into dollars. And so the demand for dollars would shift to the right. How about an increase in foreign wealth? This is kind of like a, go ahead. What's your name again? Levi. I knew that. God. Go ahead. If they deemed US goods normal goods, right? You guys remember your micro class between normal and inferior goods? This is kind of based on a normal and good argument. If US goods like a tablet computer is viewed as a normal good, then higher income or wealth should push up the demand for that good, not only domestically, but abroad as well. So that's straightforward. What about number 4? That one's interesting. A decrease in US investment risk. Why would that increase the demand for US dollars from abroad? A decrease in US investment risk. We're going to talk about more about risk and return a little bit later in the semester, but Lauren, go ahead. That's right. Yeah. So, in short, there's two things that investors care about. They care about expected returns and they care about risk, right? Most investors are risk averse, meaning all else equal, they're going to choose an asset that has lower risk with a given amount of expected return relative to another. Okay, so if U.S. investments are deemed less risky, that is, the spread of possible returns is narrower now, then you're going to have an increase in the demand for U.S. assets from abroad, right? Those folks are going to have to swap yen for dollars, and so that increases the demand for dollars. Perfect. Um, Let me mention one thing here, and I don't have it in the slides, but I think it's important to recognize that particularly with regard to 2 and 4, those should actually also change the supply of dollars, shouldn't they? If US interest rates go higher, then not only does the rest of the world want to invest here, but we want to invest here. So we're probably going to be less willing to supply our dollars to the foreign exchange market as a result of that. So I think actually the supply curve would also shift to the left. But in this slide, I'm focusing on demand. Let me do one other interesting one here, an expected future dollar appreciation. What happens to the demand for dollars from abroad if those investors think that the dollar is going to strengthen in the near future? Jameson? Demand would increase. Let's think about why. Jameson, let's suppose today the exchange rate is 80 yen per dollar and you're a Japanese investor. You've got your 80 yen, you're going to change it for a dollar today. Tomorrow, the exchange rate goes up to 85 yen per dollar. The dollar strengthens, the yen weakens, right? You can take that same dollar, convert it back into yen, and now you have 85 yen. Like magic, you've got a 5 yen return on your investment, right? That's called currency speculation, right? If you anticipate the dollar appreciating, you want to use foreign currency to buy the dollar today and then swap it back into your own domestic currency later on after the dollar has appreciated. It's the same concept with stocks, right? You want to buy stocks when they're low and sell them when they're high, okay? So that expected future dollar appreciation is also going to increase the demand for dollars from the rest of the world. Make sense? Let's do another quick example here. Let's suppose that US consumers suddenly increase their demand for Sony high-def televisions made in Japan. What would we expect to see happen then to the exchange rate in this foreign exchange market? This time, US consumers are increasing their demand for a foreign product. Lauren, go ahead. Yeah, we want to buy foreign stuff, but in order to do that, somebody somewhere has to swap dollars for yen. Okay, so the supply of dollars in foreign exchange markets is going to go up, and the equilibrium exchange rate is going to decline. The dollar will weaken against the yen. So increases in the demand for the dollar from abroad generate a strengthening dollar. Increases in the supply of dollars to the rest of the world weaken the dollar relative to other currencies. Good. Okay, just really quickly, because these mirror what we just saw for the case of demand, anything that would tend to increase our desire for either foreign goods and services or foreign assets is going to tend to increase the supply of dollars. So in this example, we had a greater US or domestic preference for a foreign good, and that increased the supply of dollars in this currency market. But what if interest rates abroad suddenly go higher? Well, now foreign assets look more attractive than domestic assets. So we want to swap dollars for foreign currency in order to buy those foreign assets. The supply of dollars increases. An increase in US wealth. Again, if we deem foreign goods as normal goods, If we become more wealthy, we're going to want to buy more of those foreign goods. That means we're going to have to swap dollars for yen at some point. A decrease in foreign investment risk. U.S. investors are risk averse in the same way that foreign investors are. If Japanese bonds suddenly become safer compared to U.S. bonds, then some investors, at least on the margin, are going to want to dump their U.S. bonds and purchase Japanese bonds. To do so, they've got to supply dollars and buy yen. And then lastly, we have an expected future dollar depreciation. Talk me through that one. Why does that lead to an increase in the supply of dollars? Jameson? Same principle, just flipped on its head, right? Or actually, you can think of it as kind of selling a stock short, right? If you have a stock that you're going to hold in your portfolio long term, and you think that over the near term, the stock price is going to fall, you can kind of pull some equity out of that by selling it now and hoping the price drops, and then buying that stock back later on at a cheaper price and keeping the difference in the money, right? Same thing here. Jameson, if you have $1 today and the exchange rate is 80 yen per dollar, then you can swap that buck for 80 yen, right? But then later on, if the dollar depreciates, then you can take those 80 yen and now purchase more than $1 later on, right? So a future dollar depreciation is going to increase the supply of dollars, just like a future dollar appreciation would increase the demand for dollars in foreign currency markets. Very good. You all seem to be getting this okay. All right, any questions so far? All right, let's apply this thinking, this supply and demand kind of apparatus to better understand an actual event. So the last two slides were just silly kind of little examples, all right? Let's apply this thinking now to try to better understand movements in actual exchange rates that we've observed, okay? So let me show you what I've got in this graph here. This graph shows you something called the trade-weighted US dollar index from 2006 through 2020, okay? Now, up to this point, we've been talking about bilateral exchange rates, US relative to the yen, or the US relative to the Canadian dollar, et cetera. When we want to know something about the value of the dollar relative to the rest of the world's currencies, one useful thing to look at is this thing called a trade-weighted US dollar index. You can think about this as kind of like an exchange rate that is similar to how the CPI measures the price level, right? It basically averages the bilateral exchange rate between the US and all of its different trading partners. So there's a ton of those exchange rates between the US and Canada, between the US and Mexico, US and Japan, US and China, et cetera, okay? And it weights each of those bilateral exchange rates by the amount or the volume of trade we have with that country. So obviously, the US-Canadian exchange rate is going to have a huge weight in this index, right? The US-Mexico exchange rate is going to be an important weight in this index, right? The US-South African exchange rate is going to receive a smaller weight. But it essentially shows you kind of what this trade-weighted exchange rate is between the US and the rest of the world's currencies. And it's an index number. Now let me focus your attention on one part of the graph, the financial crisis. What do you see happening during the financial crisis of 2008 to 2009? Over about a 1-year period there, the exchange rate between the US dollar and the rest of the world soared by, close to 20% or so, from around 85 to like close to 105. Now, can we rationalize that big strengthening of the US dollar in the context of what was going on during the financial crisis? Can we view that movement in the exchange rate through the lens of this simple little supply and demand model for exchange rate? What are the two things that would cause the exchange rate to possibly go up? Either a right shift in demand or a left shift in supply, right? Well, I would argue that it was primarily because of well, I shouldn't say that. You could think of it in terms of both, but I don't know. What do you guys think? What do you think happened during the financial crisis that may have resulted in a strengthening of the dollar, Lauren? Yes. So that I think you're exactly right. Remember, the financial crisis was not just a US event. It was really a global event. It hit Europe in particular really hard. Okay? You had many European banks on the brink of collapse. You had several European countries that were also on the verge of a debt crisis, right? Greece, Italy, Spain, Portugal, Ireland in particular were all at a point where they were about to default on their government debt. When investors see that, when they see that the Greeks are about to default on their government debt, what are they going to want to do? Dump Greek bonds and buy something safe. What is the safest asset you can buy? Well, most investors think it is US Treasury securities. These are essentially risk-free. No one believes that the United States government is really going to default on its debt obligation. So what you saw happen during the financial crisis was this huge, it's called a flight to quality phenomenon that you see a lot of times during recessions and during debt crises across the world, where people will dump, Lauren, what they deem as risky assets and want to buy something that's a lot less risky, like US Treasury security. But to buy US Treasuries, what do they have to do? They have to swap foreign currency for US dollars. So the demand for US dollars goes way up, and as a result, the value of the dollar relative to other currencies is going to strengthen. So this spike in the exchange rate was a result of that kind of flight to quality. It's interesting to see that during the COVID recession, we don't see that same flight to quality having taken form yet. After the financial crisis, the exchange rate kind of came down over the next couple of years, but then ever since around 2012, the US dollar has been strengthening very gradually against the rest of the world's currencies. Okay, questions about that? Make sense? So this is an easy kind of example of how you can use the supply and demand model. You can use it as a lens with which to view something that happened in the real world. We can explain this event here using a simple supply and demand model of foreign exchange. Lauren? But well, okay, so it depends on, over the past 14 years, this would be a time at which the dollar was pretty weak relative to currencies overall. But remember, the US dollar can be weak relative to one currency, but simultaneously strong relative to another. Relative to a whole basket of currencies from countries that we regularly trade with, the dollar was fairly weak at this point. Interestingly, I think if you go back and compare this graph to the one earlier, the US dollar strengthened during the financial crisis against this broad basket of currencies, but I believe it weakened against the Japanese yen. So the US dollar was not strengthening against every currency, just the majority of currencies. Okay. All right, let me change course here just for a moment. So when we talked about the money supply process earlier in the semester, we described, or we focused on the actions of three parties: the central bank, the private banking system, as well as individuals, right? The non-bank public. Financial markets are global. There are international kind of linkages. So it stands to reason that the US money supply might also be affected by foreign central banks, by foreign commercial banks, and by foreign investors, the non-bank public. This becomes particularly clear when central banks and governments, particularly from foreign countries, start to take actions that try to influence or intervene in these foreign exchange currency markets. That's what I want to talk about here for the next, really for the rest of class today, is what happens when governments and central banks in particular try to influence or intervene in these foreign exchange markets that we've just analyzed, okay? So let me, Santiago, you have a question? Oh, okay, I thought you were raising your hand. Let me start with a definition to make sure everybody is on the same page here. What do I mean by a foreign exchange market intervention? Okay, this is a deliberate action by a central bank to try to influence its country's exchange rate. Okay, that's a foreign exchange intervention. It turns out the Federal Reserve very seldom conducts these, but many central banks across the world that try to actively manage their exchange rate conduct these foreign exchange market interventions quite frequently. That's why I was careful in titling this section of the course, Exchange Rate Policy in the Central Bank. Although in my examples, I'm going to talk about the Fed. In the real world, the Fed doesn't do this a whole lot, but other central banks do. Lauren? Well, you can Google, there's a whole list of countries that maintain either a fixed exchange rate regime or they try to actively manage their exchange rate by minimizing fluctuations in it. China is an example. Lots of small emerging market economies have some type of fixed or managed exchange rate. And so these interventions are important. The Fed has done them in the past. In fact, there's one of the required readings is called The Fed's Foray into Foreign Exchange. And it talks about the history of how the Fed intervenes in these markets. The last time it did, I believe, was during the financial crisis. Okay, so how exactly does a central bank intervene in the foreign exchange market? Well, it's going to do so by taking actions that affect its holdings of what are called international reserves, okay? International reserves are a central bank's assets that are denominated in a foreign currency, and they are frequently used in these international transactions that I speak of. So two very straightforward examples of international reserves. A central bank's holdings, literally, of foreign currency. That would be one. So like the Federal Reserve's holdings of euros or Swiss francs are international reserves for the Fed. And they are a component of the Fed's asset side of its balance sheet. Another common one would be foreign government denominated bonds. So bonds that are denominated in a foreign currency issued by a foreign government. So bonds issued by the German government or bonds issued by the Japanese government that the Fed has purchased for the asset side of its balance sheet are part of its international reserves. When the Fed intervenes in foreign exchange markets, it's either buying or selling, it's adding to or removing these international reserves from its balance sheet. Santiago. Sorry? I don't know. I'm not 100% sure about that. I'd have to check on that. I don't see why that would have to be the case, but I don't want to answer because I'm not 100% sure. But they're nonetheless something. What's important is they're bonds denominated in a foreign currency, not denominated in U.S. dollars. Okay, so let me talk about this a little bit more clearly now. If the Fed wanted to change the exchange rate, and I'll use the Fed as my example here. Let's say it wanted to increase the value of the dollar, that is, strengthen the dollar or raise the exchange rate, then it would accomplish that by selling these foreign or international assets from its balance sheet, okay? Ultimately, you can think about what the Fed is doing here is it's taking some of its international reserves, let's say Swiss francs or euros, and it's purchasing dollars in these foreign exchange markets. In other words, the Fed is basically increasing then the demand for US dollars in foreign currency markets. That's going to have, because the Fed is a significant player in those markets, that's going to have the effect of raising the exchange value of the dollar. Okay. Now, in practice, how does the Fed go about doing this? If it has international reserves on its balance sheet and it wants to sell off those reserves to some financial institution, some counterparty, what does the Fed accept as payment for those reserves? A drawdown of bank reserves that are going to be denominated in US dollars, right? Just like an open market sale of treasury security, right? There's going to be a reduction in the asset side of its balance sheet and a corresponding reduction on the liability side of its balance sheet. US dollar denominated bank reserves would fall. Okay, the opposite. What if the Fed wanted the exchange value of the dollar to fall? They wanted the dollar to weaken or depreciate. It's going to do the exact opposite. This time, the Fed will actually buy foreign assets. It will add to the asset side of its balance sheet by increasing its holdings of international reserves. Okay? In that case, what the Fed is said to be doing is basically selling dollars and acquiring international reserves. So the Fed is essentially increasing the supply of US dollars in these foreign currency markets, which helps lower the exchange rate. Okay? And again, how does it do this in practice? Maybe I don't have to state this every time, but to be clear, the Fed is not selling dollars literally, right? What they're doing is if they purchase these foreign assets, they're going to pay for those assets by doing what? Creating brand new bank reserves in the accounts of whoever their counterparty is, one of these primary government dealers or a big bank. So the asset side of its balance sheet will rise by the value of these international reserves. The liability side of the Fed's balance sheet will rise because there's now new bank reserves in the system denominated in US dollars. That greater supply of US dollars is going to push down the US exchange rate. Okay? So these international transactions, whether the Fed is buying or selling international reserves onto or off of its balance sheet, are going to have an effect on the monetary base. Why? Because it's going to affect the amount of bank reserves in the banking system. So just like an open market operation in treasury security affects the monetary base, a foreign exchange market intervention is also going to increase or decrease bank reserves and therefore change the monetary base. So all of the implications of open market operation actually also carry over to these foreign exchange interventions as well. I want to emphasize this point some more and go through some kind of concrete examples to illustrate exactly how and why central bank interventions in the foreign exchange market will affect the monetary base. All right, so let's do a couple of quick examples here. Let's suppose that the Federal Reserve goes out into the open market, intervenes in the foreign exchange market by purchasing $1 billion worth of foreign securities. So Santiago, they're sovereign bonds from some country. Now, to be clear, I mean $1 billion worth. These bonds will be denominated in the foreign currency, right? So the number that is placed on the Fed's balance sheet is going to be the US dollar value of those assets using prevailing exchange rates, okay? We're going to resurrect our old friend, the T account here. The Fed's asset that we're going to be talking about are these international reserves. That's what matters for this exercise. What are its two main liabilities? Are the two liabilities that comprise the monetary base, reserve balances and currency in circulation, okay? If the Fed goes out and intervenes by buying $1 billion worth of, let's say, German government debt, what happens to the Federal Reserve's balance sheet? Its holdings of international reserves will rise by a value of 1 billion US dollars. How does the Fed pay for those foreign assets, those international reserves? By crediting the reserve account of the counterparty that it's transacting with, probably a big bank or some other dealer that owns government bonds directly. And so it places those reserve balances directly in that institution's reserve account. And what happens to the monetary base as a result? Santiago? Yes, because other central banks have reserve accounts with the Fed. Yeah, so it can, I think the transactions can be from one central bank to the other, but it can also be between the Fed and any financial institutions that may own those assets. Both of those are liabilities for the Fed, though. In this case, we're gonna assume that it directly increases the volume of bank reserves, and so the monetary base is then going to go up by $1 billion. So just like an open market purchase of Treasury security raises bank reserves and therefore raises the monetary base, this foreign exchange intervention does exactly the same. Yeah. Yeah. Yeah, so it's imagine, okay, so the Fed has bought some amount of foreign bonds. Those bonds are denominated in a foreign currency. How does the Fed determine what the dollar value of them, what of those bonds are? It uses prevailing exchange rates between the two. And that's where I get this, that to be clear, it's 1 billion US dollars worth of foreign bonds. That's right. Yeah, the exchange, whatever the exchange rate is implicit in that calculation. Okay. What if, just hypothetically, the Fed would not do this, but what if instead the Fed paid with currency? So Santiago, instead of another central bank, it was just some private investor that had all of these foreign bonds, and the Fed paid for it by backing up an armored truck full of cash. Then what would happen to the Fed's balance sheet in this case? Go ahead. Yeah. So here, the Fed's reserves would rise by $1 billion, but instead of reserve balances, it would just be currency in circulation. Either way you want to look at it, what do we see happening here? It's either $1 billion increase in reserve balances or $1 billion increase in currency, or some combination of the two. And so a foreign exchange market intervention raises the monetary base here by $1 billion. It has the same effect on the monetary base as a open market operation or an open market purchase of domestic government bonds. Okay, real quickly here, what if we did the opposite example? What would happen to the US monetary base if the Fed sold $1 billion worth of foreign assets off of its balance sheet? So it has a bunch of foreign currency and wants to get rid of it off of its balance sheet. It finds another central bank or a financial institution to sell it to. Its holdings of international reserves will fall by $1 billion. And how does the Fed accept payment for such a sale? By drawing down the reserve account that financial institution or counterparty has with the Fed. Reserve balances fall by $1 billion, therefore the monetary base falls by $1 billion. So once again, whether we're talking about a sale of international reserves or a purchase of international reserves, either of these foreign exchange interventions have exactly the same effect, dollar for dollar, on the monetary base as an open market operation does for these domestic treasury securities. Basically the same effect. Okay, any questions so far? We've talked a good bit now about foreign exchange interventions by a central bank. Let me dig one layer deeper here and make sure you guys understand there are really two types of foreign exchange interventions you need to know about, okay? One is what's called an unsterilized forex intervention. The other is what's known as a sterilized foreign exchange intervention. There is a big and important difference between the two that you need to know, okay? First off, what is an unsterilized intervention? This occurs when a central bank allows the monetary base to respond to its purchase or sale of foreign assets. That is, its sale or purchase of domestic currency in the foreign exchange market. The two little examples that we just went through are examples of an unsterilized foreign exchange intervention. Why? Because when the Fed enters the foreign exchange market and either buys or sells international reserve, it allows the monetary base to fully respond to that. Okay, that's what we mean by an unsterilized intervention. Alternatively, the central bank could sterilize that foreign exchange intervention by making a simultaneous action. All right, and let me be clear about this. A sterilized forex intervention occurs when a foreign exchange intervention is accompanied by an offsetting domestic open market operation, so that the monetary base remains unchanged. So for instance, if the Fed buys international reserves, it buys Swiss francs and pays for them with bank reserves, that raises the monetary base. Well, what if the Fed wants to buy the Swiss francs, but it doesn't want the monetary base to go up? What it could do is it could sell US Treasury security by an equal amount so that bank reserves go back down to where they were before. So the monetary base is not changed. That's what a sterilized foreign exchange intervention is. It's where there is an equal and offsetting domestic open market operation that counterbalances the foreign exchange intervention. So the monetary base is not going to be changed at all. Now, again, I know that can be complicated, and I want to be clear with my words here. So let's just go through an example that extends what we just did earlier. Let's pick up this example where the Fed sells $1 billion worth of international reserves off of its balance sheet. And as a result, the monetary base shrinks by $1 billion. The Fed wants to make this foreign exchange intervention, but it doesn't want to allow the monetary base to fall. So what can it do to offset it or to sterilize that intervention? Well, it could buy US Treasury bills in the amount of $1 billion. If it does that, how does it pay for them? By crediting the reserve account of these primary securities dealers. And so what's going to happen to reserve balances? They're going to rise by $1 billion and go back to a net zero position on the T account. So here we have the Fed selling international reserves, but simultaneously buying domestic assets so that reserve balances remain unchanged. Therefore, the monetary base will be unchanged. That is a sterilized foreign exchange intervention. Sometimes central banks want to intervene in these markets to deliberately change the exchange rate or to manage the exchange rate. There are many other times, however, when central banks may find it necessary to intervene in the foreign exchange market, but they don't really want to change the exchange rate too much, in which case they would want to operate one of these sterilized interventions. So there are differences between these two. Okay, any questions then about that? All right, moving right along then. So most developed economies today allow their exchange rate to kind of float freely. Developed economies, I should say. And so in those particular cases, the exchange rate will obviously respond to shifts in the supply or demand in this foreign exchange market, as we've demonstrated here today. However, central banks in emerging market economies, in developing economies, even in some developed economies, still might want to intervene in these foreign exchange markets from time to time in order to minimize fluctuations in the exchange rate. When exchange rates swing violently, that can cause a lot of economic disruption, particularly for an economy or a country that is very open to the rest of the world, that relies heavily on things like international trade and the international flow of assets. Countries that actually want to completely eliminate these exchange rate fluctuations are said to be operating what's called a fixed exchange rate regime. All right? That's a situation where the central bank intervenes in the foreign exchange market constantly in order to keep the exchange rate pinned at whatever its desired level is. That's called a fixed exchange rate regime. Now, let me ask you this. Why would a country or a central bank, why would they want to fix the exchange rate? Or perhaps I should ask it a different way. In what ways is a depreciating currency bad for the economy? And in what ways is an appreciating currency bad for an economy? If we can understand those two reasons, then we've got some compelling reasons why we might want to try to manage these fluctuations in the exchange rate. What about a depreciating currency? Why, in what sense would that be bad for an economy, you think? Josh, is that your name? Derek, sorry. Fail. Go ahead. Yes. So if there was a weakening dollar, for instance, then it takes more dollars to buy foreign goods. Foreign goods become more expensive. That can cause domestic U.S. inflation to rise. So there's to the extent that central banks care about inflation, they might want to avoid a strongly depreciating domestic currency, right? Because it makes acquiring goods from the rest of the world far more expensive. So that's a good reason why you might want to cap downward movements or put a floor under downward movements in the exchange rate. What about a strengthening currency? Why might that be undesirable? Derek? That's right. So imagine firms and businesses in our domestic economy trying to compete with firms abroad. If the dollar is strengthening, then our goods are becoming more expensive relative to the rest of the world's goods. And so our domestic exporters are losing a competitive edge. They're going to lose out on sales. And so that could lower GDP and lower economic growth. So a strengthening dollar also can harm the economy to some extent. All right. Now, in the US, we largely allow our exchange rate to freely float, but there's lots of economies that try to manage that exchange rate by using these foreign exchange interventions, okay? All right, so let's, again, go back to this supply and demand analysis in the foreign exchange market to really understand how a central bank intervention can affect the exchange rate. In the next two examples that we're going to do, I want you guys to bear in mind that we're talking about an unsterilized foreign exchange intervention. I'll talk about a sterilized intervention in just a second, okay? So here is the setup. Let's imagine that we're going to go back to our US versus Japan example, where the US is the home country and Japan is the foreign country, okay? Let's suppose that the Fed deliberately intervenes in the foreign exchange market by selling short-term Japanese government securities. So these are part of the Fed's international reserves. It's going to sell off these assets from its balance sheet. How is that foreign exchange intervention then going to affect the exchange rate? In the last section, we talked about how those interventions affect the monetary base. Let's now go one step further and see how these central bank interventions affect the exchange rate. In going through these exercises, I want you guys to think about kind of 4 effects. How does the central bank intervention affect its holdings of international reserves, first off? Then how does it affect the monetary base domestically? As a result of that, how does it affect interest rates domestically versus abroad? And then how does that carry over into the exchange rate? So let's go through this one step at a time. The Fed sells short-term Japanese government securities. What is going to happen then to the Fed's holdings of international reserves? They're going to decline. Perfect. Okay. As our international reserves decline, Santiago, there is a corresponding reduction in U.S. bank reserves, right? The balance sheet has to balance. So what happens to the U.S. monetary base? It is going to decline. So international reserves go down, the monetary base goes down, bank reserves go down. As bank reserves and the monetary base decline, what does that tend to do to domestic short-term interest rates? If bank reserves are falling or the monetary base is falling, think back in terms of that demand and supply model for bank reserves. If the volume of bank reserves are declining or the monetary base is declining, does that put upward or downward pressure on short-term interest rate domestically? Puts upward pressure on short-term interest rates, right? Okay, so interest rates in the US then are going to tend to rise relative to interest rates in Japan. Here's the key link here. So how is that going to affect the demand and supply for dollars in foreign exchange markets? Santiago? The demand for dollars from abroad should go up as U.S. assets become more attractive because U.S. interest rates are rising relative to Japanese interest rates. But the supply of U.S. dollars should shift to the left for the very same reason. U.S. assets are now more attractive than Japanese assets. We're less willing to supply our dollars to these foreign currency markets. The combination of these two things is going to result in an increase in the U.S. dollar-yen exchange rate, or a strengthening of the dollar. This is an important point. I know we're getting somewhat close to the end of class today, but the key mechanism whereby central bank intervention affect the exchange rate is by changing the level of domestic interest rates relative to foreign interest rates. I think that's the key connection. Interventions by the central bank that ultimately change the spread between domestic and foreign interest rates is what causes these demand and supply shifts for foreign exchange to either increase or decrease exchange rates. That is the key thing that links the foreign exchange intervention with the desired change in the exchange rate. Because in this example, interest rates in the US go up relative to Japan, the demand for dollars coming from the rest of the world goes up, but the supply of dollars originating in the US goes down because everybody wants to invest in US assets in this case, not just domestically, but also abroad. The dollar strengthens as a result of that. Let's do another example here. We'll do the exact opposite example. But again, so you already know the answer, but I want you to talk me through the steps, okay? The Fed intervenes in the foreign exchange market by buying short-term Japanese securities. how does this foreign exchange intervention affect the US yen exchange rate? Here is our starting point, all right, at the intersection of the supply and the demand curve for US foreign currency exchange. Go through the steps. How does this intervention affect our holdings of international reserves? How does that affect the monetary base, domestic interest rates, and therefore the exchange rate? All right, Lauren, our holdings of international reserves, what's going to happen here? They're going to increase. The Fed is buying Japanese debt. Okay, what happens to the US monetary base as a result of that? Santiago? It goes up. Why? Because the Fed pays for these Japanese bonds by crediting the reserve account of the counterparty here with newly created US dollar-denominated bank reserve. So the monetary base goes up. All right, step 3. What should happen then to US interest rate versus Japanese short-term interest rate? Santiago, they go down. Why? Because an increase in bank reserves put downward pressure on short-term interest rates. As US interest rates decline relative to Japanese interest rates, what should happen to the supply and demand then for dollars in exchange for yen? The supply for dollars should increase. US investors want to flee US bonds and buy Japanese bonds that now have a higher relative return. And the rest of the world, or Japanese investors, also want to invest in their own assets instead of ours. And so the demand for dollars weakens. The combined effect is a lowering of the equilibrium exchange rate in this model. Okay, so we see here in this case of an unsterilized central bank foreign exchange intervention, how the central bank can increase or decrease the exchange rate, right? By selling international reserves, it's going to raise the exchange rate. But if it buys international reserves, it's going to weaken the exchange rate. Many central banks around the world do this on a regular basis to try to keep their exchange rate between their major trading partners within a certain range, because large changes in the exchange rate can be disruptive for the reasons that Derek mentioned earlier, right? Avoiding a higher inflation or avoiding episodes of low economic growth. Yeah, so this last point, I mean, maybe you guys already know this, but any central bank policy that influences the domestic interest rate will also affect the exchange rate. Actually, that is an important point. Let me emphasize that. It doesn't have to be a foreign exchange intervention. There's nothing special about a foreign exchange intervention, a purchase or sale of international reserves. Any central bank action that affects interest rates domestically versus abroad is going to have the impact of changing exchange rates. So I don't have this in the slides, but hopefully some of you guys and gals were maybe a little bit uncomfortable with my line of reasoning here, particularly about how changes in the monetary base that result from a purchase or sale of international reserves change the interest rate domestically. What am I assuming there? That, for instance, if the monetary base goes up, interest rates are going to tend to go down. Or if the monetary base or bank reserves shifts to the left, interest rates are going to go up. What am I kind of assuming there, Jameson? Say again? No, not so much that, but it sounds to me, go ahead. Yeah, yeah. So remember we talked about this difference between a corridor system and a floor system? It turns out that these changes that I'm talking about probably more accurately describe a corridor system, okay? Ever since the Fed has implemented its floor system for monetary policy, where changes in the monetary base don't really affect the interest rate because it's pinned down by the IOER rate, you wouldn't expect to see those same things happening, right? But the Fed, so this is the reason why I brought this up earlier. The Fed doesn't very often intervene in foreign exchange markets. The last time it did was early on in the floor system, and then before that was when the Fed was operating under a corridor system, where changes in the monetary base would directly change the federal funds rate, and therefore change the demand and supply for reserves. But the Fed can still do similar things in a floor system. If the Fed raises the IOER rate, that puts upward pressure on domestic interest rate, and therefore should cause what? A increase in the demand for dollars and a decrease in the supply, right? Or a reduction in the floor, the IOER rate, would cause exactly the opposite. That's kind of the point of this last italicized line here, is that it doesn't require a foreign exchange. There's nothing special about a foreign exchange intervention. As long as the monetary policy action affects interest rates relative to the rest of the world, you're going to see movements in international capital to try to take advantage of that spread. They're going to try to arbitrage it, essentially, and that causes the dollar to either strengthen or weaken. Okay, so the last two examples that I did were of an unsterilized foreign exchange market intervention. As we have seen, though, in this class today, with a sterilized foreign exchange intervention, the central bank uses open market operations to perfectly offset the movement in bank reserves created by the purchase or sale of international reserves. That is a sterilized foreign exchange intervention, okay? The end result of that is what? That the monetary base is going to be left unaffected. And if the monetary base is left unaffected, at least in a corridor system, domestic interest rates will not change. And if domestic interest rates will not change, supply and demand for dollars in exchange for foreign currency should not be affected. And therefore, the exchange rate will not change. So all of these foreign exchange interventions that I've been talking about that are meant to affect the exchange rate assume that the intervention is unsterilized. If it is a sterilized central bank intervention that doesn't alter the monetary base and has no impact on interest rates domestically, it's not going to have any, it shouldn't have any impact then on exchange rate. So only unsterilized interventions are going to affect exchange rates, not sterilized ones. I don't need a graph to show that, right? If there's no change in bank reserves as a result of these offsetting open market operations, domestic interest rates shouldn't be affected. And therefore, the demand for dollars and the supply of dollars should stay relatively stable. And there should be no strengthening or weakening then of the US dollar. All right, in the closing minutes of class today, let's see if we can go over one kind of active learning type exercise here together. So this one kind of flips the script on us a little bit, where we're going to now assume that Japan is the home country and the US is the foreign country, all right? So here's the setup. In late 2012, the exchange rate between the yen and the dollar dropped below 78 yen per dollar. The Bank of Japan actively responded to that development by taking action to reduce the value of the yen. So the yen was the US dollar was weakening relative to the yen too much. And so the Bank of Japan then intervened in these foreign exchange markets. Okay, first question. Is the yen stronger if it takes more yen or fewer yen to buy one US dollar? Lauren? Fewer, right? So if the exchange rate is falling and the US dollar is weakening, that means the Japanese yen is strengthening relative to the dollar, right? Taking fewer yen to buy one US dollar means that the yen is becoming too strong. Now, Derek basically answered this earlier, right? Why would a strong currency hurt Japanese exporters? Brian, is that right? Okay. Exactly, right? US consumers can't afford these Japanese products as much anymore, and so that's going to hit GDP in Japan pretty heavily, right? Economic growth in Japan would then decline as a result of that. Okay, here's the analytical part of this question. To reduce the value of the yen, what does the Bank of Japan need to do concerning the spread between Japanese and US interest rates? I want you to use a graph of the market for yen in exchange for dollars to illustrate this. So on the next slide, it's the same picture that we've been talking about earlier, except now we have, hopefully I did not graph this ahead of time. Yeah, so I don't want to show you, well, we'll just talk through the answer together since I'm kind of running out of time. So you want to flip the model on its head, right? So now Japan is the home country. And so we're talking about here the quantity of yen that are going to be swapped for dollars in foreign currency markets. Now be careful, the exchange rate then is also going to be flipped on its head. It's going to be number of dollars per yen. So be careful about how you write those here. If Japan is now our home country, the exchange rate has to be inverted. Okay, so here's the original equilibrium point. We have this downward sloping demand for yen, in this case, that's coming from the United States, and an upward sloping supply of yen, obviously originating from consumers and investors in Japan. Okay? If Japan wanted to reduce the value then of the yen, what does it need to do to interest rates in Japan relative to the United States? It wants to reduce Japanese interest rates relative to the US, right? That way, Japanese investors would want to buy US assets, and US investors would want to buy US assets, right? In other words, what would happen in this case? The supply of yen in exchange for dollars would go up. So you would have all of these Japanese investors wanting to take their yen, convert it to dollars, and buy US assets. You would also have US investors wanting to avoid Japanese assets. So they're going to reduce their demand for yen in this particular currency market. As a result of a rightward shift in the supply of yen and a leftward shift in the demand for yen from the US, you have a reduction in the yen-dollar exchange rate, or a weakening of the yen relative to the dollar. So how would the Bank of Japan go about accomplishing this? What would it need to do? So how would the Bank of Japan accomplish a reduction in Japanese interest rates relative to US interest rates? Levi? It would increase the domestic monetary base in Japan, right? It would do that by doing what? Buying or selling international reserves. There you go. So the Bank of Japan would want to buy US treasuries, increase Japanese bank reserves, and therefore increase the Japanese monetary base, pushing Japanese interest rates down and setting in motion these demand and supply shifts that we're talking about here. See, this stuff can be confusing because all of a sudden the analysis gets reversed when you flip who the home country is. That's why I emphasized this in the last class, is be really careful when you're solving these problems or you're describing the solutions to them to be specific about who the home country is and the foreign country. That is going to determine not only how the exchange rate is written, but it determines the source of the demand and supply, right? It's the home country that supplies domestic currency. It's the foreign country that demands domestic currency, right? Jameson, sure. This is an all else equal problem, so my answer, I guess, would be no. But certainly in the real world, all kinds of events can happen that cause supply and demand to shift. But as long as the Bank of Japan kept the interest rate below, well, I would, usually in these types of financial markets, you see something called arbitrage happening, where if interest rates fall in Japan relative to the US, then you have investors trying to take advantage of higher US interest rates. Well, when the very act of doing that pushes up the demand for US assets, thereby lowering US interest rates. So the extent that these markets are competitive, you see a lot of arbitrage in general equilibrium. And so these are kind of like one-shot exercises. In order to maintain a lower exchange rate, the Bank of Japan may need to stand ready to continue to purchase international reserves. It may not be able to accomplish it long term by just doing it once. That's a very good question. Any others? Okay, so here's where we're going to go with this. My plan was to have finished this stuff by the end of class today. I'm not quite done. I've probably got 15 or 20 more minutes of one last little subsection I want to talk about on the dangers of fixed exchange rates. I do want to mention briefly this problem of a speculative attack on a country's currency that can emerge when a central bank tries to peg the exchange rate. Then we're going to move directly into the next topic in this course, which is all about the Fed's so-called dual mandate. The Fed's charge of trying to simultaneously try to stabilize both inflation as well as the general level of economic activity. So we're going to talk about the Fed's broader monetary policy goals, as well as how it implements that using what's called policy rules. Okay, so we're gonna move away from this kind of minutia about how the Fed actually implements monetary policy through changes in reserves and short-term interest rates to start talking about some of the broader macroeconomic objectives that the Fed actually has. Okay, that's where we're headed with this. All righty, see you guys later.